major economies. Clearly, the battle against inflation is not yet won, and for this reason, global interest rates remain elevated. At the same time, there has been some policy divergence which reflects different country circumstances. Since our last meeting, policy rates were lowered in Canada, Switzerland, and the Euro area, but were kept unchanged in the United States, the United Kingdom, and Japan. Among emerging markets, countries that have lowered inflation more, especially in Latin America, have been able to cut policy rates more. A concern for central banks, however, is that lower inflation outcomes have not always been sustained. Turning to South Africa, economic performance in the first half of the year was disappointing. The economy contracted by 0.1% in the first quarter, and recent data, including last week's mining and manufacturing numbers, have caused us to trim our second quarter growth estimate modestly to 0.6%. Over the medium term, we expect somewhat faster growth supported by more reliable electricity supply and improving logistics, among other factors. Our revised growth projections, nonetheless, remain below longer-run historical averages of about 2%. The risks to this forecast are assessed as broadly balanced, with ample scope for structural reforms to lift growth further over the medium term. On the inflation front, the most recent headline print for May was 5.2%. This is unchanged from April and is still in the top half of our target range. The outlook, however, has improved somewhat. Headline consumer price inflation for this year is now projected at 4.9% compared to 5.1% at the previous meeting. Over the next few quarters, headline inflation is expected to dip below the 4.5% midpoint, mainly because of fuel and food prices. The outlook is supported by the stronger rand exchange rate. The implied starting point for our forecast is now at 18 rands 35 cents to the US dollar. Over the medium term, we continue to see inflation stabilizing at 4.5%, with core inflation remaining close to this midpoint objective throughout. For inflation expectations, the latest survey results show average expectations at 5% next year and 4.9% 2 years ahead. This is still uncomfortably above the SAP's 4.5% objective and above our own inflation forecasts. However, all categories of respondents lowered their inflation expectations from the previous survey. We anticipate further progress as inflation slows, helping to re-anchor expectations firmly at 4.5%. While the forecast has improved, the balance of risks is assessed to the upside. Against this backdrop, the Monetary Policy Committee decided to keep the repo rate unchanged at 8.25%. 4 members preferred an unchanged stance, and 2 preferred a reduction of 25 basis points. In discussing the stance, MPC members agreed that restrictive policy remains appropriate to stabilize inflation at 4.5%. The committee assessed that an unchanged stance remained appropriate given the inflation risks. Some members, however, were of the view that the inflation outlook had improved enough to reduce the degree of restrictiveness. Global interest rates remain high, especially in the United States, and rates may stay higher for even longer than markets currently anticipate. This presents risks to the currency outlook. Domestically, inflation expectations do not yet reflect the 4.5% midpoint objectives over the medium term. While expectations are moving in the right direction, they continue to show the impact of the recent inflation surge. We remain concerned about administered prices. We have had to mark up electricity inflation for this forecast round, even as other categories shifted lower. Services price inflation also remains uncomfortably above the midpoint. The forecast continues to see rates easing into more neutral territory by next year. As before, the rate path from the quarterly projection model remains a broad policy guide, changing from meeting to meeting. Decisions of the MPC will continue to be data dependent and sensitive to the balance of risks to the outlook. We are committed to stabilizing inflation at the midpoint of the target band. Achieving this outcome will improve the economic outlook and reduce borrowing costs. Finally, we reiterate the views of the committee on additional measures that would improve economic conditions. This includes reaching a prudent public debt level, improving the functioning of network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains. This concludes the statement of the committee, and at this stage, we would take the questions. As usual, please identify yourself, hopefully on the platform, and we will take questions from 3 participants at a time. And hands. Okay, there is a question in the chat from Alistair Bull, with asking, with the current policy setting, how restrictive do you assess sub rates to be? And there's a question about retail sales that fell compared with the month before, whether this suggests a weakness. Let's start with the last one because it's the most straightforward one. Alistair, 1 month is not particularly helpful. The same figures show that if you look on a 3 months to 3 months basis, that actually that retail sales are seen to be up. It still reflects an economy that is weak, where disposable incomes of people had been eroded by inflation that began to rise in 2021 and is still remaining elevated. And so that necessitated a response of monetary policy, and without a doubt, it would have an impact on demand. That might just be confirmation that the transmission mechanism is actually working. Restrictiveness, how restrictive are we? As I said, there are a number of things that you could consider here. One that is generally used by central banks is simply to look at what we call the neutral real interest rate, which is the rate at which monetary policy is neither stimulatory nor contractionary, and that we estimate to be roughly around 2.5%. And if you take the current policy rate, which is 8.25%, and you use the contemporaneous inflation figure, most recent reading being 5.2, you would say that the real policy rate at the moment is around 3%. And so with the real policy rate at around 3% and neutral real rate at 2.5, you do the arithmetic, you will say we are roughly half a percent restrictive. But that is yesterday's inflation. That doesn't tell us much. We need to look at inflation into the policy horizon. And if you look at inflation at the policy horizon, we are expecting that within the policy horizon, inflation will decline towards our midpoint objective. If that was to happen, indeed, it would then suggest that with the policy rate would be restrictive by an additional 70 basis points. So that would be the arithmetic. However, bear in mind that the forecast that we had placed with respect to inflation has got attendant risks to it, which we have identified. Of course, we could use the expectations of inflation as surveyed, or we can use market the surveys of market forecasters. So you can look at all of those. Lastly, you've got to look at South Africa relative to its peers. Our inflation outlook says that inflation will decline towards target. If you take the G20 countries at the moment, South Africa has the second highest inflation within the G20. So our policy stance still has some way to go in terms of reining in inflation, and that is why members of the committee felt that the current monetary stance is appropriate to deal with the inflation as forecast, as well as dealing with the attendant risks that we had assessed to be on the upside in respect of inflation. There is a question from Atwell Dlamini, which, well, it's not a question. He says he has got a couple of questions. He says, the MPC says the inflation outlook is improving. How confident are you that South African headline inflation is cooling at the pace you are comfortable with? Well, if we were comfortable with the cooling pace, we would have taken a different stance in this meeting. We think that there are still risks, and based on those risks, we had decided to leave policy unchanged. The decision today was, please, does this signal the MPC prepared to reduce rates even before inflation reaches 4.5% mark? Well, you know, decision is split. Members express preferences, and after they expressed preferences, get engaged in protracted debates and arrive at a common position. And the common position is what we had decided to go out with. And now we need to be comfortable and see a couple of prints of inflation that tells us that indeed we are on the trajectory, and that the risks that we had identified get tilted not to the upside in terms of inflation risk, but more towards the downside. That would give us comfort. But you can't drive a car just looking into the rear view mirror. We have got to look at our forecast, and based on that forecast, take decisions cognizant of the risk that we had identified, and we decided to take the decision that we had taken today. And the MPC sees rates easing to more neutral territory. Can you please elaborate on what this means? Well, it is the QPM. It's just a path. And We take account of that, and the path in the QPM is based on some Taylor rule. And as we say repeatedly, the path that is projected by the QPM changes from meeting to meeting depending on the data. That there will be nothing more to add in terms of that. I don't see any other questions on the chat. I'm looking for hands. Oh, there is one question from Prinesha, which says the estimate for GDP impact of load shedding has improved to 0 percentage points in 26. Can we interpret this as the SAP seeing no load shedding in 2026? No, that is not what we what we are saying. All that we are saying is that the reduction in load shedding that we had seen is impact on GDP growth is reduced and has continued to reduce. We base what we have with what we forecast with respect to load shedding on the pronouncement by ESCOM, as well as what we see around the economy. We can't say to you that there would be no load shedding in 2026. If anything, I think that ESCOM did warn that there might still be some form of load shedding. We are not saying that there will be no load shedding after that. Hillary, you say the last meeting we said that the risks to the inflation forecast were balanced. Now we believe they are to the upside. What has changed? Number of things. We will come to that just now. And Alistair says that Alistair's question has disappeared. So I will leave it at that. Hopefully he will come back. Alistair, Hillary, what we have actually seen is that we had long ago identified the fact that food prices would be a risk down the line. We have seen repeated food price disinflation. And in some instances, we had actually seen almost deflation in food prices. But it seems to be very much a rent story, because when you look at the dollar price of food in some categories like cereals and the lot, the dollar price of food in terms of the FAO index is up. And when you see the rent price of food, it has come down. It is actually showing a declining trend. It's very much a rent story. We had once again flagged that the tight global financial conditions and the higher for longer that we might see would result in a realignment of exchange rate, and the rand is no exception, and that there are risks to the exchange rate. If indeed they materialize and the dollar price of food continues to climb, it would then suggest that food prices could actually turn quicker than we had said. Secondly, global inflation is declining slower than the policymakers in the advanced economies had hoped for and are actually looking for. And so you have this situation where you could have global inflation remaining elevated at the time that you think there are risks in the exchange rate. The two could together play the role of actually raising the inflation risk profile. That issue has to do with global logistics constraints or rise in global shipping prices in the main. We have seen that surge, And it had come as a result of problems in the Suez Canal, but also problems in the Panama Canal where water levels were low. At the time of the previous meeting, shipping prices had not risen at the pace that we had seen, that had set in. And last but not least is that services inflation globally had proved to be sticky and more persistent than was actually expected. South Africa had experienced a situation where services inflation had been contained, but we are seeing signs that it is beginning to rise. We do not have the figure for June, and the figure for June in terms of rentals will include a survey by Statistics South Africa that would cover the month of June. We do not know what it looks like, but private sector-based indices from rental or tenant credit bureaus are showing that rentals are actually starting to pick up, and that we might just be starting to catch up with the rest of the world, because we had had this exceptionalism where our services inflation was low while services inflation around the world had remained elevated and had been very sticky, actually going down. Alisa, is the SAP moving closer to cutting rates, and could you have enough data in hand by your next meeting in September to act? Alistair, I'll give you exactly the same answer. We are not targeting rates, we are targeting inflation. So if you want to know what's going to happen to rates, look at what is happening to the inflation outlook. Of course, the most recent prints are in the past, but the nature of inflation expectations in South Africa is such that it is very much driven by what the most recent inflation reading is. And we need to have continuous reading of inflation that shows a downward trajectory, but more importantly, that the expectations of the price setters becomes aligned with the midpoint of the inflation target range and with the forecast that the SAP has, which shows that inflation will not just decline to the midpoint, but in some of the quarters that it would dip below the midpoint. Kopano, two members were in favor of a cut. Does that mean that the path to interest rate cuts is becoming clearer now, post domestic elections and considering other global dynamics? Elections, we are not political analysts. We do numbers, but in a way, I have dealt with your question. You will get the same answer that Alistair got. Palisa says the MPC apply the principle of sufficient consensus in arriving at today's rate decision. The principle is as we had aligned. 4 members preferred a current stance, 2 preferred a cut of 25 basis points. Deliberations ensued, and the decision was that we will keep the rates the same. Ntato Tukwana Bloomberg, so to what extent does global interest rates remaining higher for longer affect your currency outlook to the effect that we might be importing inflation? Would you say South Africa's inflation is currently a domestic issue, or that it is an international issue? The answer is all of the above. That is what I dealt with earlier on when I was addressing Hillary's question. Any other questions? MPC members, anyone, anything I had missed or I had misspoke that you would like to correct? Nothing? Thank you very much. Thank you, ladies and gentlemen. Thanks for your attendance, and we shall see you at the September meeting.